All right, folks, settle in. Go ahead and pour yourself a cup of coffee. It's early, the sun's just starting to peek over the ridge, and the market's well. The markets are in an uproar. My phone started ringing before the rooster even knew what day it was. My son, sharp as a tack, works on Wall Street. You know, he's one of those fellas they call a quant. Works with algorithms that can make 1,000 trades before I can even butter my toast. He calls me up, voice all hurried. That New York minute pace. Dad, did you see it? Did you see what they did? They doubled the margin on silver overnight. Doubled it. The price is getting hammered. People are getting wiped out. Are you selling? You got to be selling. The models are all flashing red. I took a slow sip of my coffee. Let the silence hang there for a moment. I could hear the hum of his computer in the background, a world away from the quiet of my study. Son, I said in a calm voice that I'm sure frustrated him to no end, why in Sam Hill would I sell now? I'm heading to the coin shop after breakfast. They just put the good stuff on sale. He didn't understand. He launched into a flurry of technical terms. Forced deleveraging, a volatility contraction, cascading liquidations. He's a good boy and a smart one, but sometimes he can only see the trees. He forgets there's a whole forest out there. And if you're listening to this right now, chances are you might be a little confused too. The headlines are probably screaming at you from your phone or your television. Silver prices plunge. COMEX slams brakes on silver rally. An investor's liquidated in silver margin catastrophe. And all of that is true for some folks. It's true for the speculators, the hot money, the leveraged players who were trying to make a quick buck. But it's not the whole truth. It's not even the important part of the truth. What we saw happen is what I like to call a good old-fashioned paper market shakedown. It's a move as old as the markets themselves. It's a tool, a weapon designed to scare you. It's a move designed to make the weak hands fold and throw their cards on the table. It's a move designed to separate the speculators from the investors. And most importantly, it's a move that signals to me, an old timer who's seen a cycle or two, that something is deeply, deeply wrong behind the curtain. And when things are wrong behind the curtain, that's when a real asset, something you can hold in your hand, something that can't be conjured out of thin air by a computer, becomes more important than ever. So today, we're going to talk about it. We're going to pull back that curtain. We're going to talk about what this margin hike really is, why they did it, and why it makes the case for owning physical silver stronger, not weaker. We're going to talk about the great disconnect between the price on your screen and the metal in your hand. This isn't just about money, folks. This is about wealth. It's about insurance. It's about seeing the chessboard for what it is and understanding that some players can change the rules in the middle of the game. So stick with me. This is an important one. We're going to take our time and unravel this piece by piece. Chapter 1, the margin call massacre, what really happened. Now, before we get into the grand strategy of it all, we need to understand the weapon they just used, this margin requirement. It sounds complicated, like something you need a fancy degree to understand, but it's not. It's simple, really. The complexity is just a fog they use to keep regular folks from understanding the game. Imagine you want to go to a high-stakes poker game in a back room in Las Vegas. The buy-in for the game, the total value of chips on the table that you'll be playing with is $100,000. Now, you don't want to carry $100,000 in a briefcase. It's heavy, it's dangerous. So the fella running the game, the house, says, look, I know you're good for it. Just put down $5,000 as a good faith deposit. That's your margin. That deposit gives you the right to sit at the table and control a full $1,000 stack of chips. That's what a futures contract is. It's a poker game for commodities. You put down a small amount of money. The margin to control a very large amount of silver or gold or corn or oil. A standard silver futures contract on the COMEX, the big exchange in New York, is for 5,000 troy ounces of silver. Let's use some simple round numbers to make it clear. If silver is, say, $30 an ounce, that contract controls 150,000 worth of silver. But you didn't need 150,000 to buy that contract. You only needed to put up the margin. Before this week, let's say it was 8,000. So with just 8 grand, you're controlling 150 grand worth of silver. That's a leverage ratio of almost 19 to 1. For every one of your dollars, you're controlling nearly $19 worth of metal. And leverage, folks, is a double-edged sword. It's a rocket ship, but the rocket is strapped to your back. If the price of silver goes up by $1, from $30 to $31, your contract for 5,000 ounces just became worth 5,000 more. You just made a 62% return on your 8,000 deposit overnight. You're a genius. You're printing money. This is what attracts the speculators, the hedge funds, the hot money. But what if the price goes down? If it drops by $1 from $30 to $29, you've just lost $5,000. Your initial 8,000 deposit is now worth only $3,000. You've lost over 60% of your capital. It's a brutal, brutal game. And here's the kick of the house. The COMEX can change the rules of the game whenever they want. They are the casino owner, the pit boss, and the dealer all rolled into one. What they just did by doubling the margin requirement from, say, 8,000 to the 16,000 is like the casino owner walking up to the poker table mid-hand and saying, all right, boys, new rule. The $5,000 good faith deposit is now $10,000. Effective immediately. Everybody at the table, pony up the extra 5 grand right now or your chips are forfeit and you're out of the game. Now, what does that do? The big players, the JP Morgans, the Goldman Sachs, the giant hedge funds, they sigh, maybe they grumble a little to their compliance officers, and they slide another stack of chips forward. They have deep pockets. It's no problem. But the little guy, the smaller fund, the speculator who scraped together his last $8,000 to get a seat at the table because he believed the price of silver was going to the moon, he's in a panic. He doesn't have another 8 grand. He's forced to sell his position right then and there at a loss. He gets liquidated, wiped out. And when thousands of these leveraged players are forced to sell all at once, what happens to the price? It plunges. It's a forced cascade of selling, a feedback loop. The selling pushes the price down, which triggers more margin calls for other players, which forces them to sell, which pushes the price down even further. It's a massacre. This isn't an accident, folks. This is a feature, not a bug of the system. We've seen it happen time and time again. Back in the late 1970s, the Hunt brothers famously tried to corner the silver market. They bought up huge amounts of physical silver and futures contracts, and the price skyrocketed from about $6 to nearly $50 an ounce. The powers that be, the ones who were short silver and losing their shirts, got very nervous. What did they do? The exchange, with the blessing of the regulators, changed the rules. They raised margin requirements astronomically and eventually decreed it was liquidation only, meaning you could only sell a contract, not buy one. They pulled the rug out, the price collapsed, and the Hunts were ruined. They used the rules of the paper game to crush a legitimate move in the physical market. The COMEX will tell you they did this to curb volatility and protect market integrity. And in a way, from their point of view, that's true. The price was getting a little too hot, a little too out of control for their liking. A lot of people were betting on silver going up. This move was a big bucket of ice water designed to cool things off and wash out the speculators. It's a tool they use to manage the price. They can raise margins to hammer the price down, and they can lower them to let the price breathe a little. It's a pressure valve. But you have to ask yourself the most important question. Why did they need to use this tool, and why now? Why were they so afraid of the price running away from them? It's because what happens in that casino in that paper market poker game is starting to get dangerously disconnected from what's happening in the world of real physical metal. And that's where we, as prudent investors, need to focus our attention. Think about it for a second. Did the fundamental supply and demand for silver change overnight? Did the number of solar panels that need silver to function suddenly get cut in half? Did the number of electric cars, smartphones, or medical devices needing silver suddenly plummet? No. Did the amount of silver sitting in vaults around the world magically double? Of course not. The only thing that changed was a rule in a ledger book in a building in New York. A rule in the paper game. This brings me to the most important lesson I've ever learned in my 60-plus years of watching these markets. You have to know what game you're playing. Are you playing the paper game or the physical game? Because they are two very, very different worlds. And right now, one of those worlds is built on a foundation of sand. I'd be curious to hear from you all in the comments. Have you ever been involved in one of these paper markets? Futures, options, highly leveraged ETFs. What was your experience? Was it a good one, or did you learn a hard lesson like the one so many learned this week? Let me know. There's a lot of wisdom in shared experience. Chapter 2E, the two worlds, paper promises possess cold, hard metal. When I was a younger man, my father, a farmer who survived the Great Depression, told me something I never forgot. He had seen banks fail. He had seen his neighbors lose their life savings. He had seen the dollar devalued overnight by Roosevelt. He sat me down at the kitchen table one day. He took out two things. In one hand, he had a stock certificate from a local company that had gone bust. It was a beautiful piece of paper, ornate and official looking. This, he said, is a promise that was broken. Then, from his other pocket, he took out a worn, heavy silver Morgan dollar. He placed it on the table with a solid thud. This, he said, is not a promise. This just is. This is a day's wage for an honest man's work. It was a day's wage 100 years ago, and it'll be a day's wage 100 years from now. Son, there are two types of assets in this world. Things that are somebody else's promise, and things that just are. You'd be wise to know the difference. That's the best explanation of the paper market versus the physical market I've ever heard. The paper market for silver is a world of promises. A futures contract is a promise to deliver silver at a future date. An ETF, like the big one SLV, is a trust that promises it holds physical silver to back up its shares. A mining stock is a promise that a company will be able to successfully pull silver out of the ground and sell it at a profit. It's all promises. And promises, as we all know, can be broken. This paper market is enormous. It's a financial superstructure built on top of a tiny physical foundation. The amount of silver traded in futures and options and other derivatives on any given day can be 100 or 200 times the amount of actual physical silver that's dug out of the ground. Think about that. They are trading promises for more silver than is even being produced. It's a dizzying, abstract world run by algorithms, hedge funds, and massive banks. It's where the spot price of silver is determined. That number you see on the news, that's the price of a paper promise. It's the price of a chip in the casino. And like any promise, you have to trust the person making it. In the case of an ETF, you're trusting the custodian, usually a big bank like JP Morgan, to actually have the silver they say they have. You're trusting that it's not leased out or claimed by multiple parties, a practice they call rehypothecation. You're trusting a prospectus filled with fine print that often gives them all sorts of outs in a crisis. You don't own the silver. You own a share in a trust that promises it owns the silver. A subtle but critical difference. Now, let's talk about the other world, the physical world. This 1 ounce American Silver Eagle in my hand. This isn't a promise. It just is. It has no counterparty risk. That means its value doesn't depend on a CEO making good decisions, or a bank staying solvent, or a contract being honored. It is a tangible asset. It's been recognized as a store of wealth for over 5,000 years across every major civilization. It's a chemical element on the periodic table. You can hold it. You can feel its weight. You can hide it under your floorboards if you want to. Its value is inherent. The physical market is the world of coin shops, online bullion dealers, and private vaults. It's the world of stackers, people who patiently and quietly convert their paper currency into real, tangible wealth, ounce by ounce. It's a much smaller, slower, and more deliberate world than the frantic paper casino. For a long time, these two worlds have run more or less in parallel. The price in the paper market casino has generally dictated the price you pay for a coin at the shop, plus a little extra called a premium. But we are starting to see those two worlds drift apart. The great disconnect is happening. We've seen it before. Back in 2008, during the financial crisis, the paper price of silver was collapsing along with everything else. The spot price was getting crushed. But if you tried to go buy a physical silver coin, you couldn't find one. And if you could, the premiums were sky high. The dealers were sold out. The disconnect was real. The price on the screen said one thing, but the reality in the marketplace, the price to get real metal in your hand, said something completely different. We saw it again in 2020. The spot price dropped, but the premiums on physical silver exploded. What this margin hike tells me is that the people who run the paper casino are getting nervous. They are seeing an incredible amount of demand in the physical market. They see countries like India and China importing record amounts. They see mints around the world, from the US mint to the Perth Mint in Australia, running out of stock, putting their products on allocation and reporting record sales. They see industrial demand for silver, for things like green energy and technology, absolutely exploding. And they look at their own vaults, at the COMEX warehouses, and they see the inventory of registered silver. That's the silver that's actually available to be delivered to settle a contract, dwindling to dangerously low levels. So they have a problem. If the paper price is allowed to run free to reflect that incredible physical demand, more and more people with futures contracts will decide they don't want to settle for cash. They'll want to take delivery of the actual physical metal. It's called standing for delivery. And if enough people do that, the casino will run out of chips. The promise will be broken. The game will be over. That's a default. And that would expose the entire system as a fractional reserve shell game where there are hundreds of paper claims for every one physical ounce of silver in the vault. So what do? They can't create more physical silver out of thin air, but they can control the paper price. They can use their tools like these margin hikes to shake the tree. They can create a panic, force a sell off in the paper market, and drive the spot price down. This does two things for them. First, it makes silver look like a terrible, volatile, risky investment to the average person watching the news. It scares people away. Second, and this is the important part, it allows them, the big banks and the insiders who are on the short side of the trade, to buy back their short positions at a lower price. It allows them to accumulate more futures contracts at a lower price, and potentially to stand for delivery themselves and drain the remaining physical metal from the system at a discount. It's a transfer of wealth from the weak hands to the strong, from the speculators to the accumulators. So when my son asks me if I'm selling, I have to laugh. I'm not playing their game. I'm not sitting at that poker table. I'm in the business of owning the real thing. And when the casino managers start panicking and changing the rules to scare people away from their front door, it tells me that something incredibly valuable is inside that casino. And I want to own as much of it as I can before they lock the doors for good. This is the fundamental thesis. This is the core of the strategy. You ignore the noise of the paper market and you focus on the signal from the physical market. The signal right now is screaming that there is a desperate scramble for real metal behind the scenes. And this margin hike is just the latest and most blatant attempt to conceal that fact. Chapter 30, the perfect storm, why they are so terrified. All right, so we've established that this margin hike is a tool of control, a sign of panic in the paper markets. But what are they panicking about specifically? It's not just one thing, folks. It's a confluence of events. It's a perfect storm that's been brewing for years, and it's about to make landfall. Let's break down the three big thunderheads in this storm. First, and most obvious, is inflation. Now, the government will show you their official number, the CPI, the Consumer Price Index. They'll tell you it's 3%, maybe 4%. And I have to ask you, does that feel right to you? When you go to the grocery store, are your bills only 3% higher than last year? When you fill up your gas tank or pay your insurance premium or buy lumber to fix your fence? Does it feel like a small, manageable increase? Of course not. We all know that number is a fantasy, a politically convenient fiction. They've changed how they calculate it dozens of times over the years, always to make it lower than it really is. They use things like hedonic adjustments. That's a fancy term that means if your new television has a better picture, they count that as a price decrease, even if you paid more for it. They use owner's equivalent rent instead of actual house prices, which massively understates the real cost of housing. And they use substitution. If the price of steak gets too high, they assume you'll just switch to eating hamburger, so they substitute the cheaper item into the basket of goods they measure. It's a game. The real inflation, the kind you and I experience every day, is much, much higher. And why is that? It's simple. It's not that the price of eggs has gone up. It's that the value of the dollar in your pocket has gone down. And it's gone down because our own government has been printing it into oblivion. Since 2020, we've seen the money supply expand at a rate that is unprecedented in American history. Trillions and trillions of dollars created out of thin air to pay for stimulus checks, bailouts, and unending government programs. When the government runs a deficit, which it always does, it sells bonds. And when there aren't enough buyers for those bonds, the Federal Reserve steps in and buys them with money it creates out of nothing. It's called monetizing the debt. It's a shell game. It's a classic story as old as ancient Rome. When a government can't pay its bills, it debases its currency. The Romans used to clip the edges of their silver and gold coins and mint new ones with less precious metal. Our government doesn't have to do that. They just press a button on a computer. But the result is the same. The value of each individual dollar goes down. For a while, that new money sloshed around in the stock market and real estate, creating huge asset bubbles. But eventually it finds its way into the real economy. And that's what we're seeing now. Too many dollars chasing too few goods. Historically, what have people done in times of high inflation and currency debasement? They flee to real assets. They buy things that the government can't print. They buy land, they buy productive businesses, and they buy gold and silver. Precious metals are the ultimate inflation hedge. They are the antithesis of the fiat dollar. They have a finite supply. They have been a store of value for millennia. The people running the system know this. They know that if the general public ever loses faith in the dollar and starts rushing into gold and silver, the game is up. A rising silver price is like a fever thermometer for the economy. It's a vote of no confidence in the currency. They cannot and will not allow that to happen in a disorderly way. So they use the paper markets to suppress the price, to shake people's confidence, to keep the thermometer from showing just how sick the patient really is. I want to hear from you in the comments on this one, folks. This is a real kitchen table issue. What's the one item, whether it's groceries or something for your house, where the price increase has just shocked you the most over the last couple of years? For me, it was a simple bag of fertilizer for the garden. The price had more than doubled. It's a real wake-up call. The second big thunderhead is geopolitical instability and the decline of the dollar. For my entire adult life, the US dollar has been the king. It's the world's reserve currency. This happened officially after the Bretton Woods Agreement in 1944, and unofficially after President Nixon closed the gold window in 1971, severing the dollar's last link to gold. This has been an incredible advantage for America. It means we can print as much money as we want to buy things from other countries, and they have to accept it because they need dollars to buy oil and trade with each other. It's what some have called our exorbitant privilege. We export our inflation to the rest of the world. Well, that privilege is being challenged for the first time in a major way. You see what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa, and now a whole host of new countries are joining them, like Saudi Arabia and the UAE. They are openly talking about creating a new currency backed by commodities like gold to trade with each other. They are tired of being dependent on the US dollar and our foreign policy. It's called De-Dollarization. And it's not just talk. Look at the actions of the world's central banks. For the last 2 years, they have been buying gold at a record pace, the fastest since the 1960s. The biggest buyers, China, Russia, India, Turkey, they are quietly converting their US dollar reserves into tangible monetary metal. We see countries striking bilateral trade deals to bypass the dollar entirely. India buying oil from Russia in rupees. China buying oil from Saudi Arabia in yuan. Why are they doing this? Because they see the writing on the wall. They see our unsustainable debt, which is now over $30 trillion and climbing. They see our political instability. And they see our willingness to use the dollar as a weapon through sanctions. When we froze Russia's dollar reserves, every other country in the world took notice. They realized that their dollar holdings were not truly theirs. They were subject to the whims of Washington. They are building a lifeboat, and that lifeboat is made of gold. Now, where does silver fit in? Silver is gold's little brother. It's the monetary metal for the common person. While central banks are hoarding gold, a similar quieter trend is happening with silver. Countries like India have been importing record amounts. The demand from the East is absolutely voracious. They have a cultural affinity for precious metals that we in the West have largely forgotten. They understand that in a world where the dominant currency is in decline, real assets are the only safe haven. This shift, this de-dollarization, is not an overnight event. It's a slow-moving tectonic plate, but the earthquake is coming, and the people who run our financial system are terrified of it. A plunging dollar would mean catastrophic inflation at home and a loss of American power abroad. A rising gold and silver price is a direct reflection of a falling dollar. So they have every incentive in the world to use the paper markets to keep a lid on the price for as long as they possibly can. This margin hike is just another finger in a dam that's covered in cracks. The third and final thunderhead is the green energy and technology revolution. This is what makes silver's story so unique and, in my opinion, even more compelling than gold's in the 21st century. Gold is primarily a monetary metal. It sits in vaults. Its main job is to be a store of value. Silver is different. It is a hybrid. It is both a monetary metal and a critical industrial metal. And its industrial demand is about to go parabolic. You cannot have the green energy transition without silver. It is the most conductive and reflective metal on the planet, making it absolutely essential for solar panels. Every single solar panel has a silver paste in it that conducts the electricity. As the world pushes towards solar energy, with governments providing massive subsidies and mandates, the demand for silver is going to be staggering. Some estimates say that by the end of this decade, the solar industry alone could consume close to the entire annual mine supply of silver. You cannot have the electric vehicle revolution without silver. Every EV has significantly more silver in it than a traditional gasoline car, used in everything from battery connections to the electronics that run the vehicle, the heated windshields, the sensors. And it doesn't stop there. 5G technology requires a huge amount of silver for its infrastructure. Every smartphone, every laptop, every flat screen TV has silver in it. It's used as an antibacterial agent in medical equipment, in bandages, and in water purification systems. The list of modern applications for silver is a mile long. And unlike gold, which is mostly hoarded and recycled, a huge portion of the silver used in industry is consumed in tiny amounts and never recovered. It's thrown away in landfills inside old electronics. It's used up and gone forever. So you have this incredible dynamic. On one hand, you have a 5,000 year history as money in a safe haven asset with demand exploding due to inflation and geopolitical risk. On the other hand, you have exploding industrial demand for technologies that are at the very center of our future with a constantly depleting supply. And on top of all that, the supply side is constrained. There are very few primary silver mines in the world. About 80% of newly mined silver is a byproduct of mining for other metals like copper, lead, and zinc. So the supply of silver can't just be ramped up easily in response to higher prices. It's the perfect storm. It's a supply and demand case that you could teach in a textbook. And the price, the real price, has been artificially suppressed for decades through the paper market games we've been talking about. This is why they are panicking. The pressure from all sides, monetary, geopolitical, and industrial, is becoming too much to contain. The physical market is screaming for a higher price. The paper market is their last line of defense. The margin hike was an act of desperation, a move to buy them more time before the dam finally breaks. Chapter 4 of Wine, reading the tea leaves, the signals I'm watching. So, as an investor, how do we navigate this? It's not enough to just know the big picture. We need to watch the specific signals that tell us when things are starting to accelerate. I'm an old-fashioned guy. I don't have a fancy computer model. I just watch a few key indicators, a few telltale signs that have served me well for decades. Here are the 5 signals I'm watching right now that tell me the silver story is not just intact, but stronger than ever. First is the gold to silver ratio. This is a simple one. It's just the price of gold divided by the price of silver. It tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of human history, when both were used as money, that ratio was somewhere around 15 to 1. That's roughly the ratio at which they appear in the Earth's crust. In the 20th century, it averaged around 50 to 1. Right now, it's hovering at a historically high level, maybe 80 or 90 to 1. What does that mean? It means that silver is incredibly undervalued compared to gold. It's a historical anomaly. When the precious metals bull market really gets going, silver tends to move faster and more dramatically than gold. It's more volatile, both on the way up and on the way down. That ratio starts to fall as silver outperforms. Seeing that ratio consistently trend downwards, from 90 to 80, then to 70, will be a huge confirmation that the bull market is in full swing. For me, it suggests that silver has more room to run than gold does. It's the coiled spring. The second signal is industrial demand and inventory reports. I keep an eye on the numbers coming out of the big industrial consumers. The Silver Institute puts out a great report every year. When you see reports that industrial consumption is exceeding mine supply, and that above ground stockpiles are being drawn down year after year, that's a huge fundamental driver. I pay close attention to the inventory levels at the big exchanges like the COMEX and the LBMA in London. When you see the registered deliverable silver inventories continuing to plummet, that's the canary in the coal mine. It tells you the physical squeeze is getting tighter and the paper players are running out of real metal to back up their promises. The third signal is central bank activity. As I mentioned before, central banks are buying gold at a record pace. This is the big one. These are not emotional, reactionary buyers. They are planning for a world that looks very different from the one we're in today. They are making strategic, generational decisions. When you see the official institutions that run the global financial system quietly hedging their bets against their own paper currencies, you should take that as the most serious signal of all. While they primarily buy gold, that move validates the entire precious metals thesis and will inevitably spill over into silver as the poor man's gold and as a strategic industrial metal. The fourth signal I watch is the strength of the US dollar, specifically the DXY index. This is a measure of the dollar against a basket of other foreign currencies. Generally, gold and silver have an inverse relationship to the dollar. When the dollar is strong, metals prices tend to be weak and vice versa. Watching the long-term trend of the dollar is critical. As the de-dollarization trend continues, as our national debt continues to explode, the long-term path for the dollar is, in my opinion, down. A sustained breakdown in the DXY will be like pouring gasoline on the fire for precious metals. And the fifth and final signal is a simple one, the premium on physical silver. This is the price you actually pay for a coin or bar over and above the paper spot price. When that premium starts to widen significantly, like it did in 2008 and 2020, that is the market screaming at you that there is a physical shortage. It's the clearest sign of the great disconnect. The premium reflects the real world costs and risks of sourcing, minting, and delivering a physical product. When dealers are charging 30, 40, or 50% over the spot price and are still sold out, you can take that spot price you see on TV and throw it in the trash. The real price is what someone is willing to pay to get their hands on the actual metal. Watching those premiums is my number one real-time indicator of stress in the physical market. These are the things I watch. Not the daily noise, not the talking heads on financial news, not the panic of the day. I watch the deep underlying currents, and every single one of these currents is telling me the same thing. The foundation of our financial system is shifting, and the time to own real tangible assets is now. Chapter 50. My game plan, how an old-timer stacks his silver. All right, so this is where the rubber meets the road. It's all well and good to talk about grand theories and global trends. But what do you actually do? How do you translate this knowledge into a practical, prudent strategy? I'm going to share my personal game plan. This isn't financial advice, folks. I'm not a licensed advisor. This is just what an old fella who's trying to protect his family's wealth is doing. It's a simple, no-nonsense approach that I've refined over 40 years. Rule number one, physical is final. I do not play in the paper markets. No futures, no options, no leveraged ETFs. I've seen too many people get burned by them. The game is rigged, as we've discussed. The only silver I own is the silver I can hold in my hand or have stored with a reputable, fully allocated, and audited vaulting service. If I can't touch it or have it audited with my name on it, I don't own it. Period. Fully allocated means my specific bars are set aside for me, not just part of a big pool. Audit means a third party comes in and verifies it's actually there. This is non-negotiable. Rule number two, slow and steady wins the race. I am not a trader. I am an accumulator. I use a strategy called dollar cost averaging. It's a simple concept. I buy a little bit of silver every month or every quarter, regardless of the price. If the price is high, my fixed amount of money buys me a little less silver. If the price is low, like after a paper market shakedown, my money buys me a lot more. It takes the emotion out of it. I'm not trying to time the market. I'm not trying to catch a falling knife or chase a rocket ship. I'm just steadily converting my depreciating dollars into real money over the long term. I'm building my position ounce by ounce, brick by brick. Rule number three, know your dealer. I only buy from reputable, well-established bullion dealers. These are the big online dealers with thousands of positive reviews, or the local coin shop that's been in town for 40 years. I avoid deals that seem too good to be true, like some anonymous seller on a social media site or an online auction platform I'm not familiar with. The risk of buying a counterfeit product is real. The Chinese have gotten very good at making fake coins that look and feel real. You want to be sure you are buying A $9.99 fine silver from a source that will stand behind their product. A good dealer is worth their weight in, well, silver. Rule number 4, understand what you're buying. There are many forms of silver. There are government minted coins like the American Silver Eagle or the Canadian Maple Leaf. These carry a higher premium, but are instantly recognizable and easy to sell. They are like the brand names of silver. Then there are generic silver rounds and bars made by private mints. These tend to have a lower premium, so you get more silver for your dollar. I personally own a mix of both. The government coins for liquidity and the generic bars for sheer weight. There's no right or wrong answer, but you need to know what you're paying for and why. Don't just look at the price of the item. Look at the premium over the spot price. I also avoid numismatic or collectible coins. They have a place, but that's a different hobby. I am an investor, a stacker. I want the most metal for my money. Rule number 5, storage is strategy. You need to think about where you're going to keep your metal. A home safe is a good option for a smaller amount. It's accessible, but it also carries risk of theft or fire. A bank safe deposit box is an option some people use, but I'm not a fan. Your access is limited to bank hours, and in a real banking crisis, those doors might not open, and technically the contents aren't insured by the FDIC. A third-party private vault is a great option for larger amounts. It's secure, insured, and outside the banking system. The trade-off is that it's less accessible and you have to pay storage fees. I personally use a combination of these methods. Diversification isn't just for assets, it's for storage too. And my final and most important rule number 6, know a weapon's purpose. You have to understand what silver's role in your portfolio is. For me, it is not a lottery ticket. I am not expecting to get rich overnight. Silver is my financial insurance policy. It's my protection against currency debasement, inflation, and systemic risk. It's the part of my portfolio that I hope I never have to use in a real crisis. It's the fire extinguisher on the wall. You don't own a fire extinguisher because you expect your house to burn down. You own it so that if it does, you have a way to protect your family. That's how I see my stack of silver. It's a position of defense. It lets me sleep at night knowing that no matter what happens in the paper markets, no matter what the politicians or the central bankers do, I have a portion of my wealth stored in a real tangible asset that has preserved wealth for thousands of years. It's my personal sovereign wealth fund. That's the game plan. It's not exciting. It's not flashy. It's boring. And in the world of investing, boring is beautiful. So, for all you stackers out there listening, I'm curious. What's your preferred way to stack? Are you a government coin purist, an American Eagle fanatic? Or do you go for the lowest premium, the biggest bars you can find? Or maybe you like the old 90% junk silver coins from before 1965. Let me know in the comments. I love to see how other folks are building their own lifeboats. Conclusion, an old man's bet, so here we are. The dust is settling from the margin hike. The headlines are fading. The speculators have been carried out of the casino on a stretcher. And the old timers like me are quietly heading to the coin shop, a little smile on our faces. We've covered a lot of ground today. We've talked about how this margin hike was a predictable move in a rigged paper game. We've talked about the great disconnect between the promises of Wall Street and the reality of physical metal. We've looked at the perfect storm of inflation, geopolitical risk, and industrial demand that is pushing the silver market to a breaking point. And I've shared with you my own simple, boring plan for how to navigate it. The conclusion I've come to after all these years is the current financial system built on a foundation of ever increasing debt and a fiat currency backed by nothing but confidence is in its twilight years. The confidence is fading. The cracks are showing. We are at the tail end of a massive 50-year experiment that began when we severed the dollar's last link to gold, and the results are coming in. And in times like these, you have to make a decision. Do you bet on the promises of the same people who created the problem? Do you bet on the politicians who promise fiscal responsibility while racking up trillions in debt? Do you bet on the central bankers who promise stable prices while printing trillions of dollars? Or do you bet on the one thing that has outlasted every empire, every government, and every paper currency for the last 5 millennia? Do you bet on the simple, immutable laws of physics and chemistry and supply and demand? For me, the choice is simple. I'm betting on the cold, hard, simple truth of physical silver. So when they shake the tree, when they manipulate the price, when they try to scare you out of your position, I don't panic. I see it for what it is. A signal of their desperation, a sign of their weakness, and a beautiful opportunity to buy the world's most important asset at a discount. It is a gift. Think for yourselves, folks. Do your own research. Don't ever take my word for it. But don't let them scare you. Know the game you're playing and choose your assets wisely. Thanks for listening. It's been a pleasure.